Thanks for clicking. Fixed mortgage rates in Canada shot up again in August, with bond yields surging over 4% and experts debating whether or not the Bank of Canada would be raising rates at its September announcement. But even if the Bank of Canada doesn't raise rates in September, and I wouldn't be expecting any language about a pause.
Why?
But even if the bank doesn't raise rates in September, we're still a long way off from any rate relief, with Fed Chair Jerome Powell saying on Friday that the Fed expects rates to remain higher for longer. And these elevated mortgage rates comes as some Canadian banks have begun to release their third quarter earnings, showing that homeowner stress is continuing to grow, as the banks begin to address their ever-increasing amortizations. And the news that stress on Canadian homeowners is growing came the same week as we heard an analysis from Phil Comer, the global strategist at MBR Partners, saying that Canada might be witnessing the biggest housing bubble of all time, and that it wouldn't take much to topple it over. So what I want to do today is go over my best mortgage rates for the month of August, take a look at the increasing stress showing up on the books of the banks, briefly discuss Comer's interview, and then go over what to look for next. Speaking of next, we have a big couple of weeks coming up, with the Bank of Canada set to release its interest rate announcement next week, and at the same time, the local real estate board should start releasing August's real estate data. We'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. First up, my best 5-year fixed insured mortgage rate. An insured mortgage, if you'll remember, that's where you put less than 20% down. You have a 25-year amortization. You qualify at 5.25% or 2% above the contract rate, whichever is highest, and you pay the mortgage insurance. My best 5-year fixed in June was sitting at 4.99. That jumped up in July to 5.34 and has gone up since then to 5.44%, with my best 5-year variable rate mortgage sitting at prime minus 1.05 or 6.15%. So, rates are up about 10 basis points since this point in time last month, but we're also up nearly a full percent since April, when the best 5-year fix was sitting at 4.49. With that said, insurable rates popped up even higher this month. An insurable rate, if you'll remember, that's where you have 20% down. You have a 25-year amortization. You qualify at 5.25% or 2% above the contract rate, whichever is highest, and you don't pay the mortgage insurance. My best 5-year fixed insurable rate in June was sitting at 5.34. That jumped up to 5.89 last month and is now sitting at 6.09. And the 5-year insurable variable rate mortgage sitting at prime minus 0.5 or 6.7%. So insurable rates, where you qualify as though it's insured but you don't take the mortgage insurance, they're up about 20 basis points since this point in time last month. And we saw much the same when we look at uninsurable mortgage rates. Uninsurable mortgage rates, if you'll remember, that's where you either take money out of your home vis-a-vis a refinance or an equity takeout, and or you have a 30-year amortization. You qualify at the greater of 5.25% or the contract rate plus 2%, and of course you don't pay the mortgage insurance. My best uninsurable rate in June was sitting at 5.54. That jumped up to 5.89 last month, and as of this month is now sitting at 6.19. With a 5-year uninsurable variable rate mortgage sitting at prime minus 0.4 or 6.8%. So the 5-year insured rate up 10 basis points, the 5-year insurable rate up 20 basis points, and the 5-year uninsurable mortgage rates, where you take money out of your home or you have a 30-year amortization, up about 30 basis points.
Don't worry about it.
And with 5-year rates over 6% in many cases, we heard more news this month that many borrowers are opting for shorter-term mortgages, in the hope that the Bank of Canada will indeed reverse course by the time that mortgage is up. But right now, especially with an inverted yield curve, borrowers are paying a premium for that shorter-term mortgage, with a 1-year sitting at 7.29, a 2-year sitting at 6.89, and a 3-year sitting just over 6.5%. So, we have fixed mortgage rates continuing to rise, and the Bank of Canada may or may not raise rates at its September 6th announcement.
They wouldn't dare.
But, regardless of whether or not the Bank of Canada does raise rates in September, new data from TD and RBC shows that the stress of the interest rates that we've already seen is already weighing on homeowners. For its part, TD showed that 48% of its mortgages are now over 25 years, well up from the 35% from the year prior. Further, 22.8% of TD's mortgages now have amortizations longer than 35 years. And while this looks like an improvement from the previous quarter's 25.1%, and indeed it is, the improvement comes as TD is now proactively reaching out to its customers, prodding them to act when their trigger rates are met, when their fixed payments is no longer enough to cover the interest portion due to the bank. This is a big change coming from the banks, who, just a few months ago, were allowing their customers to extend their amortizations almost ad infinitum, and TD getting more aggressive with its variable rate holders might have something to do with the urging of OSFI, the urging of Canada's banking regulator, in June that the lenders address the risks of ever-increasing amortizations.
It stops today. You got it?
And TD, in a bit of a shift, is now prodding many of its customers to act, allowing them to make lump sum payments, increase their monthly payment, or lock into a fixed rate. And RBC is showing progress in this area as well, with the number of amortizations over 35 years on its books dropping from 25% last quarter to 23% this quarter. And remember, during this quarter we had 2 more rate hikes coming from the Bank of Canada. So, absent a shift in the bank's policies, we should have seen the number of amortizations greater than 35 years increasing rather than decreasing. So, with TD and RBC decreasing the number of mortgages that they have that are over 35 years, there appears to be a shift on the part of the banks, no longer allowing homeowners to increase their amortizations forever. And this is going to put major pressure on homeowners, who are going to be forced to either make large lump sum payments or see their monthly payments drastically increase. And the increasing stress put on homeowners comes as Philip Komar, global strategist at MRB Partners, says that Canada's housing market and the amount of leverage in our system makes Canada's housing bubble particularly likely to pop.
We have some risks in the situation. We see the Canadian banks really not wanting to allow it to topple. They've been trying to extend these things. But that's, in many ways, at some point it will. We've got Wild E. Coyote sitting over a cliff, and the bank's trying to hold the plank out to hold it up, but not to be too scary.
And yeah, we've seen this over the past year, with the banks allowing many holders of variable rate mortgages with fixed payments to extend their mortgages upwards of 90 years, trying to prevent major payment shocks resulting in major sell-offs, as well as a major decrease in the value of the bank's assets.
Thanks for being so helpful.
So we have fixed mortgage rates continuing to increase all across the board, over 6% in many cases, and we have an apparent reversal on the part of the banks, no longer allowing amortization extensions until infinity, both of which will be putting more and more pressure on current homeowners. With that said, whether or not the Bank of Canada will be raising rates at its September announcement remains to be seen. On the one hand, we do have an economy that appears to be slowing, with retail sales down and many predicting that the bank will take a wait-and-see approach. On the other hand, the Bank of Canada very well might want to kick this into high gear. Kick the inflation fight into high gear, put that inflation genie back in the bottle, in the hopes that if something does indeed topple over, it can rely on those lower rates to prop the economy back up. With that said, when the bank does make its announcement on September 6th, we will have an update out on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.